Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is Stephanie Link, Chief Investment Officer at The Street. Stephanie, hello, and welcome back.
Thank you for having me.
I should also say you are the co-portfolio manager of Jim Cramer's Charitable Trust.
Yes.
So I want to start out a little bit just with the sort of macro picture. We've had a great rally in stocks, and since the recent announcement of QE3 by the Fed, we've seen risk assets take off again. But then there's this lingering concern out there about the fiscal cliff as we come towards the end of the year. That certainly hasn't been resolved. And we're starting to see these the angst in Europe percolate up again. Where do you think we are now in terms of this cycle?
We've had an enormous move, up 15% in the last 15 weeks, right? So it's easy to take profits. And with Spain and Europe back on the front page for now, it's even more easy to take money off the table. But I would say that you can't get too bearish, because here in the U.S., the economy is actually getting a little bit better.
It is, right?
Yeah, it's about 2% GDP. It's not where we need to be. Jobs are nowhere where we need to be. But housing is definitely improving.
A big area, the housing,
huge area.
yes.
And also consumer confidence and retail sales, auto sales. Consumer has stayed okay. I think the problem here in the U.S. is the manufacturing side of things. And I think that's the reason why the Fed is actually going after housing, to try and offset and lift the housing market, because you do have this manufacturing overhead. And that's tied to the global economies. Now, in the global economies, I don't expect anything in Europe. Nothing. I do expect Spain.
Well, austerity.
Well, yeah, that's right.
That.
That's right. But I do expect that Spain will ask for money, obviously, and for support. But I don't expect to see growth in that region for some time. In fact, quite a recession at least to the end of 2013 into 2014. But China is kind of interesting, right? I mean, they've done an enormous amount under the radar. They haven't announced a huge stimulus program, but targeted stimulus programs. And
how so? I mean, it's mostly been monetary, on the monetary side, hasn't it?
Well, it has been. We've had 2 interest rate cuts, 3 RRR cuts, but we've also had some infrastructure spending stimulus as well. And they're small, but they've done a few of them, and I expect they're going to do more. And I think that you will see 6.5–7% growth this year in China, but I do think you'll see an acceleration into next year. And we're seeing it already, some of the effects from Brazil and some of their cuts and their monetary policies from the last few years. So I think it's hard to get really negative with the global monetary easing out there. And so that's why actually on these pullbacks,
you want to be a buyer.
Yeah.
But let's talk a little bit about commodities and hard assets, where, you know, if we're talking about a global scenario where growth is going to stay relatively weak, let's say 2% or sub 2% here, China's coming down, Europe maybe flat if we're lucky, then is there a rationale behind, you know, a strong reason to be heavily invested right now in materials stocks?
Well, I think so. Number one, these stocks are extremely depressed in valuation, discounting a lot of bad news. I know they can go cheaper, but they're awfully cheap now. Number two, you do have this global easing. So you have, you know, a floor, and you have people buying gold for certain, silver, platinum. Platinum is a little bit of a different situation. But I think that there has to be a place, given you have this easy monetary policy, for hard assets. We've chosen to do, instead of gold, energy, because I think all commodities will continue to go higher, and that is a sector, believe it or not, that's underperformed. One of the worst groups year to date in the S&P. So I think there's some value there.
And energy, clearly you have the geopolitical factor that could be at play at any time. I mean, you have tension over there, and everything that we've seen recently with the assassination of our ambassador in Libya, the uprisings in Egypt, and of course the Iran situation, and what will be the resolution, if any, there, perhaps even conflict, right?
Certainly, and so my thought is, if oil can stay above $75, these companies print money. We know that, right? In fact, many companies will say it, as long as it stays around that level, projects are going to be built, you're going to need services, you're going to need a lot of different parts and people and that kind of thing. So that's an area where I think that there is opportunity. I don't think that, I think gold is fine. I get a little nervous when everybody's talking about gold and everyone's rushed in.
Right.
So that's why we're looking at other commodities. I'm also looking at iron ore. I understand iron ore prices have weakened considerably, but the companies that we look at are the lowest cost producers. And so if you see any kind of a pickup, not this year, but maybe next year, I think you have some real value.
How about steel? Steel as well. We've seen a lot of the steel stocks really depressed recently. Would you be going in there?
I think iron ore I'm more favorable on iron ore, but steel certainly, particularly because the stocks have come down so much. The one commodity I'm less excited about is aluminum because it's easy to make. It's hard to get some of this other stuff. It's hard to make these other high quality iron ore. So if you can find a company that can do it at a low cost, that's where your advantage is.
Now, what do you think about the fiscal cliff? Do you think we will fall over the edge of that, or will there be some kind of a deal put together in the 11th hour?
I think this might be wishful thinking on my part, that I do think we will get some sort of a deal. I can't imagine that our government is going to put us through that again after we just went through it a year ago.
I wouldn't put it past them.
I know,
Tell you.
I know, and that's why it might be a little bit more wishful thinking. That said, I think that if we get through, we've got to get through the elections, and then obviously we'll have better indication, but we also have to get through earnings. So there could be some volatility between now and then, and that's when I think you want to be a little bit more aggressive on the market.
Let's talk about the elections for a second. Do you have a different outlook or a different forecast based on who gets elected, if you have an Obama second term or if Romney gets elected?
Well, I think the markets would rally under Romney, most because of the more favorable tax treatment, but also the repatriation and the use of the cash that's overseas to really make it attractive to bring it here and spend. And so those are the two kind of areas. It looks like Obama is certainly leading the cause here. I think we kind of muddle through. Unfortunately, with Obama, I don't see the job market getting a whole lot better. But then again, if we can get housing to go and we can get consumers, their finances get a little bit better as they save a little bit more, they pay down their debt, we get corporates to continue to pay down their debt, I think we could continue to go
And
higher.
housing, of course, the largest asset of most people.
That's
and
right.
if prices start to go back up, that'll give the wealth effect, the positive wealth effect.
Sure.
And we've seen the effect already from just the announcement of QE3, where the Fed is targeting mortgage-backed securities. We've seen rates come sharply down in the past 2 weeks, right?
Yes, and so that's a theme that is well exploited in the press. But I still think there's room there. I definitely think there's room there. If you look at Case-Shiller, if you look at CoreLogic, which actually gives you a much broader reading of home prices around the country, you're looking at prices of up 3.4%, up about 4% sequentially, month over month. So you're definitely seeing a rebound. Nowhere where we need to be again, but definitely making some steps. And I think there are a lot of ways to play that theme, and I think it has legs into next year.
Do you think the overall inflation fears that many people talk about, that's a little bit overblown?
Way overblown.
Way overblown.
Way overblown because labor costs are still under pressure. And that's the majority of what, if those start to go up, that's when you get worried about it.
Biggest input into the production cycle
70%.
is, that's right.
That's right. So,
that's right.
So to me, that starts to change, that's when you get worried. The rest, I think, we can go up a little bit. And the headlines might be a little bit ugly, but on the whole, no, I don't think that we are at risk in the near term.
All right, so Stephanie Link, I'd say you're cautiously optimistic.
Absolutely. Looking for places to put our money on the dips.
All right, sounds good. Thank you very much.
Thanks.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.